one of the things we spent a little bit of time on was just recapping the fact that we'd finished off our strategic plan period in FY18. We announced 5 years ago a number of targets that we were going to meet, and we met every single one of them. So I think that's a pretty major achievement over that course of time, both to put that guidance out there and to meet it or exceed it. So just specifically on that, sorry, I'll get the page happening. Yes, you should have page 4 up there in front of you. So just in the middle of the page, one of our key ones for financial investors was to get that return on assets up from 4% to 8 or 7.5% to 8%. We hit the 8% mark at the end of FY18. We ramped up our delivery pipeline, so we said we'd hit 500 plus deliveries by the time we got to FY18, and we did that. We delivered 506. And we've sold down pretty well all of our non-retirement assets now. So we've got a composition of 97% of retirement assets, 3% in all other, and pretty well all the other will be gone by the end of this year. We've got a really high resident satisfaction rating, which is just worth talking about briefly, because you do see media about, suggesting otherwise. But, we couldn't have achieved these results unless we really had the support of our consumer base in all of that. Over the last 5 years, and to an extent that we probably didn't imagine at the start of the journey, we've evolved to become a really substantive healthcare organisation now. Just to give you a feel for that, we'll do over 500,000 hours in our care facilities this year and about 240,000 hours in our allied health businesses. So, that's pretty substantial. We weren't doing anything like those numbers when we started out in FY14. While we've achieved all those financial and other targets under our strategic plan, we are trading well under NTA at the moment, roughly 40% down. And that, as Joe mentioned, has caused a bit of frustration. And we think the circuit breaker in that process is to say to the market, we will undertake a strategic review, and one of the very specific options that might come out of that is to introduce capital, read potential equity partners in our business in a way similar to what you've seen in the Lend-Lease recent transaction with APG Asset Management, buying 25% essentially on the valuation metrics that we value our business on. I'll come to that in a moment. But before I do, just quickly touching on the numbers. So we announced a stat profit yesterday of 365.1. That was up fully 44%. And a bit of the media you read this morning talks about valuations. Really, a lot of the driver behind that was in the underlying profit, which came through. It was up 17% to $127.2 million. Whichever way you cut it, both of those profit numbers were record numbers. Our earnings per share, underlying basis, 22 cents per security, and we've given guidance for FY19 current year of 20.4 cents, which is $117 million. Our net tangible assets were up to $3.92, and that's really relevant in the context of the review. So let me just take you to that for a moment. One of the key things to note out of this is we routinely, as the only listed operator in the ASX 200 and the only one focused entirely on retirement, we routinely get a lot of interest both from overseas and in Australia about people wanting to invest in the industry. They see it as a growth sector globally, and they're really interested in terms of getting in to do something in the sector. We've really been a leader in the industry. Our results show over the last 5 years really strong positive growth going forward. As I mentioned before, we're trading at a 40% discount to NTA. That NTA is calced on independent valuations. It's done by Deloitte, and their valuations reference other transactions that are happening in the market. So for example, the Lend-Lease transaction is relevant in all that valuation exercise. And so what that means is, where we're trading at a huge discount to NTA at the moment, you have to wonder whether that is overcooked in some way. We have been to NTA before, back in mid-June of 2017, we were at NTA. We know the factors that have come into play since that period of time, which were doubts around the recovery of our sales post the adverse media events, and what might happen in the regulatory space. And I think a really third runner in that process is the class action and what might happen there. So we think we've dealt with a lot of that. Our sales have recovered very strongly, and I can take you to the slide at the end of the pack where I talked about that yesterday. We are now back at the levels that we were experiencing not only at the end of FY17, but very similar to what we experienced through most of FY17, our last normal year, if you like. So, we've dealt with those sales issues. The regulatory environment has really settled down. Each of the 4 major states where we operate have passed their legislative packages. There is absolutely nothing in those that causes any concern for the model. The only things that you'll see pop up over the next period of time probably will be an announcement in New South Wales for an ombudsman, and we support that. The industry supports that. and nothing is going to happen in Victoria before their state election in November this year. So all of that is quite settled. So again, I think that factor is overcooked. And I think the class action is really struggling to get numbers. It's been on a very delayed timetable, and we're bringing cost applications in that, introducing some pressure to seek to have that dismissed. So as I mentioned, one of the major factors behind the review would be to look at the potential for bringing a capital partner in. I think there are 2 or 3 major areas that partner is likely to come from. We have the underbidders in the Lend-Lease process, which was only concluded this time late last year, calendar year, so they are still around. We routinely get interest out of Asia for people both interested in exploring into this country and investing here, but also with the idea of potentially taking the model back up to Asia. And there are a number of global funds that have expressed some interest from time to time as well. In all of this, the attitude of our current major shareholder, Malfa, and Seng-Wan Lee is our chairman, is really important. So he's very strongly supportive of this review, and as indeed is Malfa. Malfa have been a really patient shareholder. In fact, the kind of shareholder that you'd like to see coming in, who understands that there is value there. They certainly see value up to NTA, and I would think well beyond that, because in market briefings that we've done before, we've said that there's another $1 on NTA over and above, where we are at the moment in the next 2 to 3 years. So they believe that, and effectively, we would love to see partners coming in who have that same view and who are prepared to be patient. Of course, with the review, it's not the only thing that the review might encompass, but where one of the specific aims is trying to bridge that value gap between where we trade and what our properties are valued at, it's a really quick and powerful way to bridge that gap. That's probably all I wanted to say on that. Retire Australia, I should just say, is the other notable investment in this country, where a major fund, Infratil, the New Zealand fund, has come and invested in 50% of that. And in both the Lend-Lease and the Infratil transactions, they were essentially done on valuation metrics that are the equivalent of our $3.92. I think that's a really important point to make. Now, if I just take you to the contracts that we announced yesterday, I just want to spend a little bit of time on this because these are really market-leading contracts. We've had Aveo Way in the market for 3 years. We announced 2 variations to that, the Aveo Essentials package, which I won't spend much time on. The real sustainable competitive advantage for us comes out of our new Aveo Certainty package. So because we've got a number of really well-run care facilities, we've got 5 residential aged care facilities of our own. We've got 27 Freedom facilities. They're spread up and down the eastern seaboard. So what that does is what the contract does is allow for people to transfer, for example, out of an independent living unit anywhere in our 93 villages and go to one of those care facilities. And the benefit is if they go to a Freedom facility, there's no double DMF charged on that transaction, and they can live right through to end of life in a Freedom facility, or they can go to a residential aged care facility and have a really preferentially priced RAD, that is a bond, put in place, effectively about half to 2/3 of what the market price would normally be. Their equity in their product equals the bond, and it's just not a cashless, but a pretty seamless transaction to make all of that happen. So the point behind this, and not many people have picked up on this so far, but this is a competitive advantage that simply no one else can offer in this country because they don't have the care facilities. In terms of our sales update, we spent a little bit of time. I won't be able to go through this in a huge amount of detail, but what this graph is showing is, because there has been some noise in the market about the fact that the resi market is softening off, and the theory goes, well, that means you're going to have way less sales. Because there's a needs overlay in our business for people buying our product, that's not what we see. We didn't see it during the GFC when resi sales really slumped down, and we're not seeing it at the moment. So to take you quickly through the graph, what we've done is the auction clearance rates in the 4 major capital cities where we operate. We weight those indices to where we have products. So we've got 40% in Queensland, 30% in Melbourne, 20% in Sydney, and 10% in Adelaide. So that graph is the weekly of that weighted average. So it's plainly fallen away from 72% down to 54% last week. But what you can also see in the grey bar, the blue bar, and the dark blue bar, those are our bookings made, our bookings seen, and the contracts that we write. It's showing a recovery during FY18 from the adverse media that we copped in the first quarter of FY18. But what it doesn't show, because if you look at the fourth quarter of FY17, the fourth quarter of FY18, which is when we'd recovered, and the first 6 weeks of this quarter, we're writing essentially the same number of sales, 21, 22 sales in each week. So what that graph is all about is saying that we have recovered those sales levels. We've got a good base to work from, notwithstanding that auction clearance rates are falling away. And what our real challenge is, as it has been every year, is clearing the new stock that we've delivered in each year. So the 500 we delivered last year have got to be sold this year. And that implies that we need to lift that rate from 22 odd to about 30 a week to get there. So I'm just a little over time at the moment. I'll quickly go through our outlook. So we're seeing our sales rates returning to a little over 10% for the year. We will deliver all of the 418 new deliveries that we're well started on at the moment. And our focus is going to be on realising the cash out of that new development product and reinvesting it in so that we've got value being created in the business as we go forward. We've shown really strong innovation in the sector. In fact, I think we lead the sector, and that is going to continue. And the sort of capital partners that will be attracted to us will come in because of that innovation factor. As I said, our guidance, our underlying EPS guidance is for 20.4 cents per security, and we'd propose to declare a distribution probably in the mid-range of that 40 to 60% of underlying profits.